So how do you know when to sell your stocks? That is one of the most commonly asked questions that I get. And here's a great way to tell. You ever take your wallet out and then something like this happens? This is fine. Nothing to see here. Everything is just fine. Yeah, you can never be too sure, but usually that's a great way to sell your stocks. It's a good sign. But sometimes the signs are just not that obvious. So how do you know when to sell? That is what we're gonna explore today, but first, come on. I know you want to. Smash that like button because that intro was fire. And also, I've risked my life and limb for that intro because while you're not here, you can't tell, but I've inhaled all the fumes, so I think I've lost half my brain cells. So now I'm hoping to make up for it with all the likes. So let's begin. Hi, my name is Andrei Jikh, and if you've been investing for a while now, or if you're just getting started, at some point or another, you will have inevitably found yourself in this position. You open up Robinhood, and then you check, and you see that one of your stocks is down 42%. So you start panicking and thinking, should I buy more? Should I sell it? Should I buy real estate instead? Or Bitcoin? Don't do that. Or maybe do. This video might age very poorly and I will look like an idiot a few years from now, so I'm just trying to cover all my bases. Now this video is going to be a little more complicated and a little more wordy than my usual videos, but I promise you will get something out of it. They did a study on over 80,000 individual investors, and what they found was that on average, the stocks that people bought after selling their original stock went on to perform worse than the one that they held on to originally. It's kind of like when you were in school and you colored in C on the Scantron and then you later changed it to B because you thought it was B but it was C all along. Lesson learned, when in doubt, always pick C. But when deciding which stocks to sell, we often look at the past performance, when in reality, we should be looking at the future potential growth earnings of the company, but our fear and our emotions get in the way. However, the reverse is also sometimes true. We'll be up a lot on a stock, and then we start to wonder, should I sell some of my stock to at least make some money? With stocks, we can experience something called the sunk cost fallacy. It's a theory that says that we continue bad behavior as a result of previously invested resources. So we start to think to ourselves, well, I've lost this much already. I'm just gonna keep holding on to this stock because, well, how much worse can it get? I've lost this much money anyway. And I've made this mistake many times, both as an investor and as a human. When I was dating somebody, I knew I shouldn't for a lot longer than I needed to, because if I don't, all that time would be wasted. I can't just throw that all away. Be honest, that might have been you in the past, but when it comes to anything in life, especially investing, we need to let go of that thought process. Unfortunately, no one has a crystal ball that's going to predict the future. In fact, no amount of emotional paralysis or technical analysis is going to reveal the truth about when to sell your stocks. In fact, I'm going to be 100% honest with you and tell you that the right answer is, I don't know when to sell your stocks. I don't know. Nobody knows. Not even paid professionals who do this for a living. Because think about it. If they did know, they would all be multi-billionaires because all they would do is short stocks every single day successfully every time they tried it. But that's not reality. So how is it this video is so darn long when you just said you don't know, dude? Because there are some signs that are going to help us make a more informed decision. This is going to be heavily borrowed from Simply Safe Dividends. It's an incredibly resourceful website, and here we go with the top 5 rules for helping you decide which stocks you may want to sell in the future. Sell rule number 1. You may want to sell a stock when you see the company's long-term profitability go down. So they did a study looking at stocks between 1990 and 2010. What they found was that stocks with the highest trend in earnings growth returned 11.5% per year, which is a lot if you're not sure how much that is. And stocks with the lowest trend in earnings growth returned only 1.5% per year, which is lower than inflation. So even though it's a positive number, you're actually still losing money. Just for comparison, the top 500 companies in the US have returned 6.3% per year on average. So basically what that means is companies that can grow their earnings will actually see their stock prices move higher over time. But there is a catch. So imagine a coin for just a second, or better yet, let me just make one real quick. Hiya. So two sides to a coin. On one side is short term and on the other side is long term. That's not how it works, but just go with me on this one. So on one side, profitability can be affected by the short term or it can be affected permanently. For example, if it's something like an election cycle that we're about to see happen pretty soon, then stock prices are gonna fluctuate and they're gonna potentially drastically move down lower as investors get scared over politics and uncertainty. And right now, the stock market really seems to be preferring deregulation policies. So if those policies don't get reelected, then the stock market's gonna go drastically even lower. But that's a short-term worry and that's no reason to sell your stocks just yet. But on the other side of this coin is the long-term effect on profitability. So let me give you an example. The energy sector, which I started investing in 2014, have some of the worst performing stocks in my portfolio. In this case, something like a mass movement away from fossil fuels would have a permanent and drastic effect on long-term profitability. So if I'm an investor in oil companies and I'm noticing that people are not buying oil because now we have cheap electric cars, which we don't have yet because the Tesla Model 3 is still way beyond most people's incomes and no one's even competing and coming close for bringing something like Tesla for cheaper. So we're not just there yet. Or maybe if we had electric airplanes that have several hundred passengers we could carry from A to B across the world, which we don't have. Or maybe electric boats and cargo ships, which we don't have. You get the idea. We don't have mass adoption of alternative sources of energy just yet. But if we were close to it and the oil giants were not innovating, then that would have a permanent effect on profitability, and that might be the time to consider selling. Another example is changing consumer preferences. So if you're noticing people stop eating at McDonald's and instead choose to eat healthy foods, then it's time to snap back to reality, because that ain't never happening, because America, where greasy food is always gonna be cheaper, and that never made any sense to me. You would think good healthy food would be cheaper, but it's actually way more convenient and cheaper to just eat junk food, which also explains my unhealthy Taco Bell obsession. And rule number 2 is not one I'm particularly good at doing, but I have done before, and that is selling an excessively expensive stock. And I can give you no better example than the ultimate hype machine right now, and that is Tesla, and its valuation is worth more than Ford and GM combined, which is insane. Now, I'm not saying Tesla can't do better than those companies in the future. It might, but as of right now, it's not, and it should not make sense for it to be as expensive as it is. So when that happens, you can consider selling some of the stock and then waiting to buy more when it becomes more reasonable and cheaper. And if you want to do rule number 2 effectively, then you want to specifically look at the price to earnings ratio. Now, if you're using the Robinhood app like I am, then go ahead and enter the ticker symbol for a stock, scroll below the chart, and you'll see P/E ratio. And that's what you want to be looking at, that little doodad right there. Now, the stock market's average PE ratio floats between 15 and 20 on average. And at some point or another, it reverts to this average. We don't know when, but eventually it does. And if a stock goes above 30 PE ratio, that's when it's time to start looking at it a little bit more critically and maybe consider not buying a stock that has a PE ratio of 30 or higher, or maybe start selling a little bit of your own stocks with that high of a PE ratio. Now, in Tesla's case, the PE ratio is sitting at 0 or negative. What does that mean? Does that mean it's a great buy? Yes! No, that's not what that means. That means that Tesla's return on equity is actually negative. People are losing value in their investments despite the stock price going higher. What this means is there's a fundamental disconnect between reality and its hyped up price. And Tesla stock could double or triple by tomorrow because in the short term, the stock market never makes any sense because it's a popularity contest and popular kids always win in the short term. But in the long run, they suck because because they always lose. I was never a popular kid. I don't know where this is coming from. I guess I have pent up history that I didn't even know existed and I'm just venting now. But what I mean is the Tesla stock price will eventually return to its normal fundamental price. We just don't know when it's gonna happen, but it could go to $3,000 tomorrow for all we know, and I would look like an idiot. So I'm just covering my bases here. And rule number 3, if the size of your position becomes overly large, then you may consider selling. So if you're a dividend investor like me and you start to notice, oh wow, this one stock is paying me quite a lot of money, you may consider pulling back so as not to let that balloon into a large percent of your income, because if the dividend gets cut, then you lose a big part of your income. I don't know, Russian comes out sometimes. I keep track of this sort of stuff in terms of diversification and income on my Patreon page, where I built a spreadsheet that tells me this kind of stuff and automates it for me, because subtle advertising, because no one sponsors my videos, so I sponsor my own. Another way to look at it is if the market value of one of your stocks exceeds 5% of your entire investment portfolio. So if we check my spreadsheet right now, just visually speaking, you can see that Apple, Johnson & Johnson, and Norfolk Southern have organically grown to be 4.9% of my entire investment portfolio. And that's fine because it's within the range. But if you find yourself with above 5%, then you may consider selling some off and leveling that off so that it doesn't represent such a huge risk. 5% is not the definitive rule, it's just what I've used and I've been really comfortable with it, so I do it. And rule number 4, sell when you have a better investment idea. And it doesn't even have to be another stock like most investors will tell you. It could be a bond, it could be real estate, it could be your education, it really could be anything. And in the case of my stock portfolio, there are definitely some losing companies in here whose money I could probably put to better use by buying something with a higher earnings growth potential or a higher, safer dividend yield. But fortunately for me, there are enough winning stocks in here that more than offset any losses, that more than make up for it. And that's not because I'm a genius. I am, but that's not why. Just kidding, I felt stupid the moment that came out of my mouth, but it's because I've been investing for such a long time, and that's why it's more important to spend time in the market rather than trying to perfectly time it, because if you try to time it, you have to be right twice, both when you go to buy the stock and then when you go to sell it. And sell rule number 5 is probably one of my favorite ways of keeping track when to sell a stock. Obviously, as a dividend investor, it's my goal to have my dividends passively fund my lifestyle, right? So if I notice that a company is dangerously close to cutting its dividend because the payout ratio is just so high, that is a good time to sell the stock. And every single month I make Robinhood update videos about how much I'm being paid with dividends, which companies pay me, and in every single one of those companies I include a dividend safety score that is borrowed from Simply Safe Dividends, and it shows me if a score is too low, then I will consider selling that stock. Most investors will wait until after the dividend has been cut to sell, but by then the share price will have dropped significantly, and by then it might be too late. You want to find them ahead of time. Even the best investors get it wrong 40% of the time. As Phil Fisher put it, if you did a great job buying the stock, the best time to sell it is almost never. And Warren Buffett said, if you don't feel comfortable owning something for 10 years, do not own it for 10 minutes. So the big takeaway here is to study all these little rules and to always remember that you can and will be wrong from time to time, because nobody has a crystal ball telling them about the future. So avoid at all costs buying those courses telling you that they know the answer, because the truth is, they don't. So don't let your emotions get in the way, and remember, the more times you try to end up buying and selling stocks, the more likely you are to end up losing money, just like I did when buying this stupid wallet. But it's the coolest thing, so worth it. You're just checking out, standing there, and your fire ignites, your wallet ignites. I look like the devil. All right, I'll stop this. Spicy. Look at that, there's not even anything inside the wallet. How crazy is that? No, I will not tell you where I got it from, and if you post the link, I will delete it because I'm petty like that, and I want to be the only cool kid with a fire wallet. That's it, guys. Love you all. Enjoy your week, and I will see you all on Monday, and then Friday, and then Monday and Friday, and so on and so forth. See you soon. Bye-bye.